Welcome to Financial Analysis Part 1, where we will talk about profitability.
Profit is quite important for almost any business and organization. And normally we say the bigger the better. But we will also like to analyze in comparison to the size of the company, the size of the company's activities, and the size of the invested capital. So this is the normal way we measure how good they are to make profit. And we have some key ratios telling us how good they are. Apart from, making the profit itself, the key ratios measure the profit against the resources put into the organization to make the profit. So of course, a small company where we have very few resources or very little invested capital, if they make a profit of 1 million compared to a huge company also making 1 million but with an enormous investment behind it, then of course the small company is doing relatively much better, and the invested capital there is having a much better rate of return. So this is what we're going to analyze in the financial analysis of a company's profitability.
Some of the most important key ratios here in the column B, and here you see the calculation formula, and here we have added some comments to the key ratios. And be aware that you can find other names of some of the things mentioned here, as for instance result of operating activities, can also be result before financial cost, or earnings before interest and tax, EBIT. So that's the common thing about the science of economy. They use a lot of different names for the same thing. The one important thing here, or the most important key ratio, is return on capital employed, ROCE. It is telling the profit that we make, earnings before interest and tax, compared to the total investment shown in the balance sheet. And I have here below a typically income statement and a typically balance sheet, and here you can see what is invested totally in the company, total assets, total liabilities. So in 2016 there was invested 8,900,000, because as you can see all the figures here is shown in thousands. So how much do we make in profit when we have invested almost 9 million for a year? The profit is shown over here in the income statement for a year, whereas we know the balance sheet is at a certain point of time. So in this case here, at the end of the year 2016, we had invested 8,900 or 8,900,000, and we take that as an expression for how much we have invested for the whole year. Sometimes we also take the average of the starting point and the end of the year. So for instance, if we would take 2017, the starting point of 2017 would be ending 2016 plus ending 2017 divided by 2, then we have the average of 2017. We can discuss what is most normal, but the easiest thing is to take the end of the year and say, well, we take this as an expression for the used capital over the year. And this is what we will do to calculate return on capital employed, and then we get a feeling on how much profit we make compared to the total invested capital. We would also like to see how much profit do we make compared to the total activities. How busy are we? Now, how busy we are, it's, another term of turnover, because the more turnover we make, normally we'll say the more busy we are. So operating margin is the result of the activities compared to the turnover. So it doesn't help us very much if we are busy making a very high turnover, but if we have no operation margin of the turnover, then of course we'll make no profit. So we will here measure the operating result of the operating activities against the size of the turnover. And we multiply by 100 here in order to get it in percentage. Now this is the formula, but we can also, instead of multiply by 100, just when we calculate in Excel, press the percentage sign up here, and then you can see the percentage dial will make the calculation as a percentage. So you don't need to multiply by 100. I'll show you later. So another thing when we talk about profitability is how much have we actually invested? Now the operation margin is telling us how much are we making in profit from the turnover. But how much have we invested to make the turnover? Now, if we, for instance, say that we have a huge stock in order to meet any customer's demand, and we have a huge place where people can come in, so buildings and facilities, we have invested highly in those, and we have a low turnover. Well, then we use a lot of money to create a turnover, and that is what ATOR is showing us, or rate of assets turnover. It can also be named ROAT. But as I said, many names for the same thing is quite common in the economy. Two others key ratios is cost of debt or return on equity. So return on equity you can compare with return on capital employed, but here we are only measuring against the shareholders or the owners or the company's equity. And here you have actually your own choice if you want to choose to analyze the result before tax or the result after tax compared to equity. Now, tax is a special thing in the profit and loss accounts. It's something coming from outside, and it can't be discussed if tax really is a cost in the financial perspective of accounting, because what we say is costs in the income statement is actually costs which we use for making the profit. And when I say that, you can hear that tax is not a cost the company is using to make a profit. All the rest of them here, cost of sold goods, personal staff cost, depreciation, financing, all these costs are necessary, otherwise we wouldn't take them, in order to make the turnover. But the tax is, when we have made the profit, you could say that there are three ways of splitting the profit before tax. And that is, one, the tax are getting first, then there are leftovers, and they will be shared by the owners and the company. The company gets what is called retained earnings, so that will be in the company, and the rest will go to the shareholders. So tax here is a special thing, and as I said, you can choose what you would like to measure against equity. In my point of view, result before tax will give a better consistency when you compare year after year the development in the equity, because tax, can be a special calculation. So if you want to analyze the development, I would suggest you use result before tax, but it's up to you. So these are the key figures telling us about how good is this organization actually to make profit compared to the resources and the activities in the company. Now, what demands can we give the company to the level of these key figures? Well, the return on capital employed, of course, as an investor or an owner, you always have other options where to put your capital. And the easiest one, and the one with absolutely no risk, would be to place your money in the bank or in a good normal interest rate. So we should have that at least when we place them in this company, plus an add-on for the risk that the company is not able to deliver a return on our investment. And well, normally we say that the market interest rate is national bonds, 10-year bonds, because they are absolutely regarded as absolutely secure. However, the interest rate there is at the moment very low. I think below 0.5% or so. So when we measure against market interest rate and add on for risk, it's a very low demand we can set for the companies in that perspective. However, we can also use another perspective. We could measure against other companies in the same line of business. So if we know that, let's say that hotels are generating a profit of return on capital employed on 4%, and this hotel here is only 1%, well, then we would quite certain give them a message that is that they're not living up to the market standard in this line of business. And the same goes for the return on equity. Here we also will use, some standard market measurements on how good the company is doing. Okay. There is one important correlation that you should know when we explain the return on employed capital growth. That is, the return on capital employed equals to the return, the operating margin, and the asset turnover ratio multiplied. I can show you later in the video. Okay, so I'll leave you here with the formulas and some comments you can study, and I will just calculate the key ratios here so you can see how it's done. I've made solution down here. And if we take the return on capital employed, I will just go up and get the EBIT, the earnings before interest and tax, in 2016, and here I have already made this cell C43 as a percentage cell. So it knows, Excel knows I have to multiply by 100 and multiply by 100, sorry, and put a percentage sign within the cell. So I can just now, without multiplying by 100, I can divide by the total invested capital, and it's your choice if to take the assets or the liabilities. It's of course always the same. So you can see here now that we have a return on our capital of almost a third. So it's 2,480,000 against 8,900,000. So it's quite good return on invested capital, and I can copy that now because in the next column here and in the next column here we have the same figures. So, and in 2017 it's even higher. So you can see here again, I take from 2017 the EBIT divided by the total employed capital. Okay. Operating margin. Well, now we're going to measure against our activities measured with the turnover. So how good is the turnover measured in profitability? Okay. So, you know, when we sell different articles, we have some articles where we have a higher profitability around because the cost of goods sold are much lower. So they are of course much more fun to sell. So that's one way to get a higher operating margin. But in average for all articles sold in this company, we'll now calculate the total operating margin. So I will take the EBIT, or the result of the operation, and divide it now with turnover in 2016. And from our turnover we make a profit of almost 11%, and I can copy that over to 2017, and we can see we have a decline here. Assets turnover ratio. So this is a figure telling us the correlation between turnover and the assets. Also, that means the correlation between turnover and the total employed capital. And of course we want a high as possible turnover compared to our invested capital. So it will be very nice if we, without any investment capital, can make a high turnover. So that will give us a high turnover ratio. So let's see how big the ratio is. I will take the turnover and divide by the total assets. And I can see that the assets, so to speak, has been turned over 2.55 times for the whole year. And I can copy that to 2017, and it's increased to 3. The next key ratio, cost of debt, is the percentage of our debt which we pay in financial expenses. I can just show you here how we calculate that. We take the net finance expenses and compare it, correlate it with, and now I have to put it in brackets because I have short-term debt plus long-term debt, like this, and I've already marked it as a percentage, so I don't need to multiply by 100 and so. And we can see here that there is an increase in the expenses, and it's relatively higher. You see there's a decrease in long-term debt. So of course here we see that the cost percentage is increasing. And some economists like to compare the return of the total capital with the cost of debt, and like to see, well, we would like to earn more in the company than the cost of debt. Then you maybe can say that you make a profit on your financing. However, in my opinion, it's a little arbitrage discussion, because you make a profit on your business. But anyhow, we can see that the cost of debt here is increasing. Return on equity is quite similar to return on the capital employed. However, here we are only focusing on, of course, the equity, so the owner's share. And here we, as we talked before, are going below the financial expenses. So we can make a pick and say we want to calculate return on equity on profit before tax, or in some cases you could also choose the net profit after tax. I choose to calculate the return on equity on the profit of the company before tax. Okay, divided by equity. This, quite good actually. What do you think? To get a payback after a year of 37%? Not too bad. Quite good actually. We can analyze further and say, well, how much is the change in percentage? So if I take the, oh, sorry about that. I'll take the result of 2017 and minus with 2016, I can see that I have a change in 3 points. 3 points. Okay, but I want a change in percentage. So when I measure changes in percentage, I compare it in percentage of the starting point, always from the starting point. So actually, how many percent compared to our starting value is 3%, and I can calculate that by putting that in brackets. So I now know that the change, the 3%, measured as a percentage of the starting point. So the change in percentage is 11%, and the change in percentage points is 3%. So I have to know the difference between those two. And I can copy that. I can make a Control C. Then I have this dotted line around it, and I can place it anywhere I want. And I mark these areas here, and then I can say Control V, and I have now copied into these areas. This one here is not a percentage, so, well, I think I can copy that down there as well. Yeah, it's 18%. Even though that in points it's only 0.45, it is changing, but it's 18% compared to the starting point. So here we can see the changes in our key ratios. So the level, that's why when we comment, when the result of the analysis, we'll have to comment on the figures to explain, is it good or bad, what can be improved, and so on. So we can say that the level is really good, and the development is also quite good. We have an improvement of 11% of our return on capital employed ratio. However, we can also see that the decline in the operating margin is 5%. So the improvement here is generated by the asset turnover ratio. Okay, so actually we have used our capital much better. So that is in fact the reason that we have a better return on capital employed. Yeah, and I have made the comments down here. So when you are asked to comment on the key ratios, you have to comment on the level, the development, explain why the development is going as it is, and you can also compare the rows to cost of debt, and of course level and development of return on equity. And I have made the comments here for you to
to read how it could be done. Of course, this is not the financial analysis is not ending here. We must remember that the figures that we have are telling the truth. However, they are not telling the whole truth. We have to go behind the figures and make interviews, perhaps doing more research. For instance, you could go into each line here and say, what's the difference here? What's the change in not in percentage, but in real numbers? Okay, and you can put in another column, and you can then calculate it in percentage. And I'll say minus this one and put it in brackets, and then I will divide it by the starting point like this, and I will make it a percentage. I think I've made a mistake here. The change, it's an increase. Oh yeah, it's of course the D23 minus the C23, and of course now I have the change, so I don't need to calculate it here. So it's of course this one here like this. So it's an improvement of 21%, and I can copy this down, and now I can see what is the changes in any cost issue or the turnover. And a good resemblance is to say, well, the change in our activities measured in turnover is 21%. Cost of sold goods has increased more. It has increased 25%. Okay, so even though that I have an increase in my gross profit, I have something here to deal with. The cost of sold goods has increased more than the sales value of the sold goods. So I have to interview now the salesperson and the purchaser and say, what is happening here? Is it the change in the product mix, or what is happening? But you see, now I look at the clock, and I've already talked for almost half an hour, and of course this is all far too long. But it's just to tell you that financial analysis is in fact a never-ending story, because we have to come to the bottom of this and find out why have we this situation that even though that we have a good increasement in our return, we have something to work on here with the operating margin. Okay, but however, I think I will bury my enthusiasm now and leave you to it. This is an example of how we make a financial analysis, go in depth in the figures, finding out what is happening in this company here, calculate the key ratios, calculate the development, make some comments on what is the situation and the development, and if you have time, go perhaps a little bit deeper into the development, and of course interview in the organization what is happening, and then make some changes on behalf of what you have found in order to improve and use what you have calculated in order to manage the company in the way that you can increase your profit and increase your return on capital employed. So this is sustainable economy. Okay, good luck. Thank you for your time. I hope you can use it, and I will be looking forward to see you in the next video.